Ever wonder if there's a kind of secret sauce to investing? A way to get better results without just piling on more and more risk? Well, it turns out there is. And it's not magic, it's math. Today, we're going to dive into the statistical science behind building a truly smart investment portfolio. This right here, this is the fundamental question for every single investor. It's the tightrope we all have to walk, right? Balancing that hunger for big returns against the very real fear of big losses. So let's figure out exactly how to solve this puzzle. Here's our roadmap. We'll start with the basic trade-off, then meet two statistical tools called covariance and correlation. After that, we'll uncover the real magic of negative correlation, find something called the efficient frontier, and finally, see how this all plays out in the real world. Okay, let's jump right into part one. Risk versus return, the fundamental trade-off. We all get it. Higher returns usually mean higher risk. And pretty much everyone has heard the advice to diversify. But here's the thing. Diversification isn't just about randomly buying a bunch of different stuff. There is a powerful science to doing it right, and it all comes down to understanding how your investments dance with each other. So how do we measure that dance? Well, that brings us to part two, and our very first tool, covariance. Put simply, covariance just tells us the direction of the relationship. If the number is positive, it means when one asset goes up, the other one tends to go up too. If it's negative, they tend to move in opposite directions. It's really our first clue as to how two investments behave together. And our source material uses this fantastic analogy. Covariance is like that first handshake. It's an introduction. But its value can be all over the map. It's a diva because its scale makes it really hard to interpret. If one asset is in dollars and another is in yen, the number can be huge, even if the relationship is weak. So what we need is a better, more reliable tool. And that brings us to part three and a much, much better tool for the job, correlation. So if covariance is the unpredictable diva, correlation is the seasoned diplomat. It takes all that raw info from covariance and neatly standardizes it on a simple universal scale that always runs from -1 to +1. All of a sudden, that messy, hard-to-read number becomes a clean, easy-to-understand score. This chart lays it out perfectly. On the left, you've got covariance, which only gives you direction. But look at the right. Correlation gives you both direction and strength. It tames that unbounded, hard-to-compare number and turns it into a simple score from -1 to +1. That makes it the perfect tool for comparing any two assets you can think of. So what does this actually look like? Well, a positive correlation means the dots on a chart trend upwards. As one thing goes up, the other tends to go up with it. They're moving together, like two dancers perfectly in sync. And a zero correlation, it looks more like a random cloud of dots. There's just no clear trend. The moves in one asset don't really tell you anything about what the other one's going to do. They're basically each dancing to their own beat. Now, this is all useful, but it's not where the portfolio magic really happens. That magic, the key to cutting risk without just tanking your returns, is found when assets move in opposite directions. And this brings us right to the heart of it all, the magic of negative correlation. Okay, let's use a real example from our source. On their own, stocks offer a pretty sweet return, but they come with high risk. Look at that standard deviation of almost 15%. Bonds, on the other hand, are much safer, with a risk around 7%, but, the return is a lot lower. So what happens when we mix them? Well, if we build a portfolio that's 60% stocks and 40% bonds, the combined risk suddenly drops to just 6.24%. I mean, look at that number again. Let that sink in for a second. That's right. The combined portfolio is actually less risky than just holding 100% bonds, which was supposed to be the safe asset. How is that possible? It's because in this example, the stocks and bonds have an incredibly strong negative correlation of -0.97. When one zigs, the other zags. They cancel out a huge amount of volatility. This is the so-called free lunch of diversification. So, how do we take this amazing principle and use it to systematically build the best possible portfolio? Well, that brings us to part 5, finding the efficient frontier. The level of correlation you have literally shapes your investment options. If it's a perfect +1, there's really no benefit. Risk just goes up in a straight line with return. If it's 0, the line starts to bend, which is good. You're getting more return for each bit of risk. But with a perfect -1 correlation, the curve bends like crazy, letting you slash your risk while still building returns. And when you plot out all the possible combinations, you get this curve. The efficient frontier is just that top edge. Any portfolio on that line is considered optimal. It gives you the absolute highest return possible for that specific level of risk. And the real sweet spot, the portfolio with the lowest possible risk, is that point furthest to the top and to the left. This all sounds fantastic in theory, right? But does it actually work out here in the real world? Let's wrap up by putting this theory into practice. Check out this real-world case study of a fund called Zeus Fund I. They found a solid negative correlation between their stocks and bonds, and by mapping out their efficient frontier, they found their sweet spot was a 20/80 stock-to-bond mix. At that point, their risk was tiny, just over 0.5%. And get this, that was significantly lower than the risk of just holding the bonds by themselves. This is real proof that the theory really works. So here's the bottom line. By finding assets that don't just move in lockstep, and especially those that move in opposite directions, you can literally build a portfolio where the whole thing is stronger and safer than the sum of its individual parts. It's not just about what you own. It's about how those things interact. It's all a complex dance. And now that you understand the steps, you can start to lead that dance instead of just getting thrown around by the market. So the real question is, how are you going to choreograph your portfolio now?